This is the first part of Chapter 3, which is consolidation subsequent to the date of acquisition, after the date of acquisition. We have two or more separate companies that operate year after year after the initial combination takes place. Each company has separate records. Each company prepares its own financial statements. However, for presentation to the public, all of these separate statements have to be combined, consolidated into a single statement. There are three methods that are used or may be used to account for the subsidiary internally by the parent. They can use the equity method, the initial value method, or the partial equity method. Each one uses exactly the same entry for the acquisition, the fair value of the acquired assets, what we've done many times before. The method chosen does not ultimately affect the totals presented for the combined companies. It's just a question of how the parent company chooses to do its own accounting. We're going to look at the equity method first. Remember, when a subsidiary earns income, the parent's investment account increases, and when the subsidiary company pays dividends, actually declares dividends, the dividends reduce the investment. Amortization resulting from the original excess fair value is always recorded, and any unrealized gains on intra-entity transactions are deferred, put off. Investment recorded by the equity method, acquisition made in the current year, and its parent, and they acquired an investment in Sun for $800,000. So they acquired this on January 1st. They paid $800,000 for $600,000 book value of Sun. They allocated trademarks were undervalued, patents were undervalued, and equipment was undervalued. The trademarks had an indefinite life, patents had 10-year life remaining, and equipment had a 5-year life remaining. So the equipment was overvalued. But the total was $120 here. They paid $200, so the remaining $80,000 is not identifiable, and therefore it's goodwill. The excess annual amortization would be nothing because there's an indefinite life for trademarks. For patents, it would be $13,000 a year. And for equipment, it would be negative $6,000 a year for the first 5 years, because after 5 years, then we're going to have this go away. It's going to all be amortized. That would change our annual amortization. Just wanted to point that out. On August 1st, Sun declares $40,000 in dividends to be paid on August 8th, and they recorded at the end of the year $100,000 net income for 2020. Just to remind you, we Parrot paid $800,000. We got an investment, so we recorded the investment at its cost. Because the book decided to do both of these, we recorded dividends receivable and a decrease in the investment in Sun. And then when we got our money, we simply got rid of dividends receivable and showed that we acquired the cash. And then at year end, we wanted to show that equity in Sun, parent and Sun, I should remember that, in the subsidiaries' earnings was $100,000, which is what they earned. And the investment in our subsidiary is $100,000. And then the last thing we have to remember to do is to take care of this excess amortization, the $7,000. So that decreases our investment and it decreases the equity in their earnings. So after we've done all of the real entries, real like in our financial statements, we have an investment of Sun that started at $800, went up by $100, went down by $40 for the dividends, and $7,000 for the excess amortization. So in our books now, we have $858 as our investment, and the equity in the subsidiary's earnings for 2020 is $93,000. Now, we want to combine our financial statements, consolidate them. We want to eliminate the investment in Sun because it's an investment in ourselves. We're squashing these two companies together. We want to eliminate Sun's equity accounts because everything is our equity. We want to eliminate any intra-company dividends paid by Sun to us, eliminate the equity in the subsidiary earnings, and then record the current amortization on the excess fair value of Sun's assets. All right, it's a tall order. Let's say we have a worksheet, or we put together a worksheet. We know all of the information from each company's separate financial statements. We take that information and we put it into a worksheet. So this is all what's done by each company separately and will remain separate. And then what we want to do is figure out how we're going to combine these to reach our goals. Remember, our major goal here is to eliminate the investment in Sun and to eliminate their equity and their retained earnings, so that all we're left with is our own equity and retained earnings. And that's exactly where we're going from here. We're going to take this and move it over here. How we do it is we do these consolidating journal entries, and they're only for purposes of consolidation. They're not in either company's financial statements. They're just to consolidate. So we wanted to get rid of, if you will, the investment in Sun by getting rid of its beginning retained earnings, its additional paid-in capital, and its common stock. In other words, we want to start out the year clear. We'll deal with their earnings from January 1st to December 31st in a minute. So we want to get rid of the common stock. We want to get rid of the additional paid-in capital. We want to get rid of their beginning retained earnings, and we do that against, there's our $600,000, against our investment. And I have these numbers, these letters backwards, I believe. Yes, that should be A, and that should be S. All right, so they should at least look right. Okay, so there's your $600,000. Then the next thing we wanted to do is get rid of the trademarks, the patents. We don't want to get rid of, we want to write up to fair value, or write down to fair value in the case of the equipment, at acquisition date, the assets and liabilities of the subsidiary company. So we're going to say patents were undervalued by 130, trademarks were undervalued by 20, and equipment was overvalued by 30. And then we remember that, in fact, we also had $80,000 in goodwill that doesn't appear in either of these financial statements, but actually exists. So we want to put in goodwill here. So there's our entries for these four guys, and 1, 2, 3, 4. And the balancing account is, again, take it out of investment in Sun. So those are done. Okay, it's a mnemonic, it's a memory device. What they're telling you for your consolidating entries is S, A, I, D, and E. So if that helps you remember SETI, you could say Sadie if you want to spell it Sadie. Anything that helps you to remember these. It's not important what order you put these down in. Okay, then I want to eliminate, again, let's see. I want to eliminate Sun's equity accounts, and then I want to eliminate the equity in the subsidiary earnings. Okay, the subsidiary earnings were here. Equity in the subsidiary earnings we figured out was 93. That's a credit because it's in the negative, so I want to debit that, make it disappear as I go across. And where am I going to go with that but to take it out of investment in Sun? So I've removed all of these guys now from the investment in Sun. Okay, and then my next step is to eliminate any dividends paid from the subsidiary to the parent, or from Sun to parent, and that was $40,000. So I'm going to take out dividends paid are normally a debit. They reduce retained earnings. I'm going to take it out of dividends paid and take it out of investment in Sun. So if we can find dividends paid here, we have 40,000. That's a debit because it's a positive number here. So a debit minus a credit leaves me only with the 120, but it eliminates those two. And then I want to debit investment in Sun, and lo and behold, if you put all of these together, you'll find that there's a zero balance here. Okay, so I did SAIE, SAID, and then E, I want the excess amortization. So I figured out that I want to eliminate, I guess the best way to put it is I want to increase the amortization expense for some things and decrease for others. If you remember that the equipment was overvalued, so it should have been less, and if the equipment was valued at less, then its depreciation should have been less. So I want to go ahead and do both of these entries. So I wanted to do patented technology. I wanted to increase the depreciation, and with equipment I wanted to decrease the depreciation, and then I wanted to go back up here and increase amortization expense and decrease depreciation expense, which I did. Now, to get your consolidated totals, it's a worksheet, so you go across. 1.5 plus 400 is 1.9. 700 and 232 is 932. That's a debit, that's a credit. Just go for it. Two debits and another debit is 165. Two debits and a credit is 110. We wanted to eliminate this, and besides we have a credit and a debit, and it worked. Now, you don't add across, you add down for your totals. So if you add these guys, you'll get this number, like that. All right, retained earnings across. This one. Now this is a, be careful with this. I'll tell you right now, and be careful with this. Even though we normally go across, I did make note here, from above. What happens in basic accounting? You do an income statement. You get net income. Net income goes to retained earnings. The ending retained earnings balance goes to the balance sheet. So be sure that you don't go across with these, but you go down with these. So I had 840, I brought that down. When I eliminated a debit and credit here, when I eliminated the 40, I got 120. And again, I add these guys down, just these guys, and you get 1.413. Okay, and then we go across 1.440. Investment in Sun with 3 credits, and the debit is 0. The rest of these we add and subtract across, and then we add down, and we get 3.561. For the liabilities and equity, again, we go across, except for here where we pull this down because that's what we put into our balance sheet, and we get that number. And I have no idea why I've got this, but let's get rid of it. Okay. I think I pasted over something else. All right. So there you go with your totals. The debits equal the credits on the balance sheet. Everything worked out. Here are the formal entries. And don't forget what your goals were, and you accomplished these.